Recording. So welcome to the webinar for those who are live and who will watch the replay. So my name's Jacqui Brauman and I run TBA Law, and I've got some great relationships with people, and one of those is Emily Lanciana, who's on the other screen in front of you, who is at Apt Wealth and financial planning. And so this is the second time, in fact, that we're running a webinar together. Last time was a little bit more general and for women who were sort of more approaching retirement age. But this time we're getting a bit more specific about financial literacy for women, which I think is a great topic. So thank you for coming and agreeing to do this again, Emily.
No worries at all. Thank you for having me.
Yeah, no, I think that it's really timely and important to have this sort of information readily available for women. And what I wanted to do before we jumped into your amazing content was just share a few stats. So I'm going to share my screen and I've just got a couple of stats. Like, this is something that I'm quite passionate about, not particularly just financial, but for women generally. I think the more educated we are, the more empowered we are. And I said recently as well, just because a woman might become wealthy doesn't mean that they're empowered. They also have to have a good understanding of how things work as well, I think, which is why this topic is important. So I pulled some of these stats out just to sort of frame our conversation today. So Finances are a great little resource for women, and they do a quarterly report. And so the last quarter report was that still a quarter of Australian women don't have any super, which is it's just shocking to me. And I suppose that might be the older end of the spectrum, because I suppose a lot of us coming through now will have some compulsory super, but still a quarter of women. This other stat makes me angry. 62.6% of the work women do is unpaid. And it's because, you know, we're the ones cleaning up after people, cleaning up the office, cleaning the house, doing all the stuff that needs to be done. So our paid work is actually a fairly small percentage of what we're doing in our lives, apparently. 55% of women are those going into higher education, which I think is amazing and just shows women's intelligence. But then that is not crossing through to our later life. So straight away for women coming out of university, the pay gap is already nearly 5%. So our graduate girls are still getting paid less. And at a graduate level, you wouldn't think that there should be much difference at all in graduates. So why is there a pay gap? And that might be because of the industries that women tend to go into. But yeah, it'd be interesting to see how that figure changes over time. The average gender pay gap in Australia is still 14%. And that's obviously average. Certainly in the industries that Emily and I work in, I think that the pay gap is bigger. It's certainly up around a 50% pay gap for female barristers, which I think is just horrendous. And that's why I always make sure I employ a female barrister if we need one. The average super pay gap is 28%. And I'm not sure if that 28% takes into account all the people who don't actually have super. So I think it might just be as people get to retirement age, the difference in the super once they need it. And then the other stats, I jumped on and had a look at a study that was put out by Hilda, and they actually looked at the financial literacy of both genders, and unfortunately we're both pretty financially illiterate. So women, out of this survey, 35% of women got all the questions right, and of men, again, it was still just under 50% of men getting all the questions right. So overall, like, women are less financially literate, but we're not very literate at all. From another organisation called Life You Choose, I got the stat that at best only 42% of women, which is a huge number, are just treading water financially. And I take that to mean that they're really going week to week and not saving and not thinking about the future. And then from Women's Health East, 73% of people on an age pension are women. So there's a number of reasons for that. I think partly because we don't have the super, partly because we live a hell of a lot longer. And I don't know if I could live on $410 a week. So I just wanted to share those to sort of frame what we're talking about today, because I think that it just makes me more passionate and fired up when I have some stats. I don't know about you, Emily, but it just makes it that much more blunt.
Yeah, it definitely shows the harsh reality of it into perspective.
Yeah, and one of the stats I didn't put up there was that we know in the last few years that women over 55 are the group that is becoming more and more at risk of homelessness, which again, just those women have given up their working life, the age where they can work, to care for other people, to have kids, to support their husbands, and then they end up either divorced or widowed with nothing and homeless. Shocking. So how can we be more financially literate?
Perfect. So I'll just quickly share my screen. Actually, I think that you've just disabled my share screening abilities. So I'll just get you to enable that if you can.
There we go. That should be it.
Yeah, there we go.
Beauty of tech. Here we are.
All right. So today I thought we'd go through, the importance of understanding your finances. As a woman, there are two main cases that you might find yourself being forced to re-educate yourself regarding your finances. And we see this a lot in our industry. And my aim as a financial advisor who does specialize in women is to make sure that you don't have to re-educate yourself under stressful environments. So the first is obviously divorce, when the other spouse predominantly looks after your finances and you're going through legal proceedings of a divorce whilst having to educate yourself about finances. And that's a position that you don't want to be in. Another is death of a spouse. And often women outlive their partners and they're forced to re-educate themselves. And yes, they can seek the advice of a financial planner, but the process of educating yourself and even taking those steps to see an advisor can be stressful when you're trying to mourn and in a situation where you've just lost your partner. So that's why it's really important and definitely a motivator for me to try and educate women young. So the first thing to do when you're trying to understand your finances is determining your short, medium, and long-term goals. At the end of the day, this is the most important thing that you can do. And once you have written down your goals and quantified them, you should then speak to experts in particular fields to determine how you can achieve these goals. So for example, if you want to buy a property, whether it be a new home or an investment property, speak to a mortgage broker, find out things like what's your borrowing capabilities, what will your monthly repayments be, how much do you need to save as a deposit. That way you're equipped to achieve those goals with the knowledge at your forefront, rather than finding out when you actually want to achieve that particular goal. So just being prepared in the lead up is the most important thing. Also prioritizing your financial goals. Often people think that they can have it all, and we would like to think that, but unfortunately, sacrifices do need to be made in order to achieve some financial goals. So you may not be able to take 2 overseas holidays per year if you want to purchase a new house. You may have to cut that back down to 1. So it's just about, determining what you're willing to sacrifice to achieve these goals. Now, a lot of people have no idea where their money is going. They simply just tap and go, which is the way of this particular generation, which is fine, but you're really going to empower yourself when you keep yourself accountable and find out exactly where your money is going. So the first thing to do is determine all of your monthly income sources. So it may be your salary and wages, it may be some rental income, it may be some dividends, and just quantifying that amount and putting it in a spreadsheet or a budgeting application. Then determining all of your monthly expenses, and it's better to overcompensate than to undercompensate, because often we find that people are in a little bit of denial about where their money is going. So being completely upfront and accountable with where your money is going. And this will determine a surplus cash flow. And we're going to talk about options for surplus cash flow a little bit down the track. So you can use, a simple Excel spreadsheet, or you can use a budgeting app. Now, there's a lot around. Your big 4 banks have them attached to their apps. So I bank with Commonwealth Bank, and they've got an option for you. But Apt Wealth also provides its own budgeting app, which is called My Prosperity, and I tend to use this instead. What it does is it categorizes all of your spending into different categories. So, for example, food, dining out, fuel, other car expenses, expenses to do with your pet, those sort of things. And then you can set budgets for each of these categories, and it will keep you accountable. You can also set goals within the app. So say you would like to save $10,000 by the end of the year, and it will give you a monthly update to how you're tracking with this particular budget. So it's definitely beneficial and tends to keep people on track and accountable. So understanding different types of debt. This is a big one. So often people think that debt is bad, but you can definitely make debt work for you rather than against you. So good debt is those types of debt which are deductible. So that includes investment loans through property or shares, whereas bad debt is non-deductible debt. So things like your mortgage, personal loans, or credit cards. So our philosophy is to pay off your non-deductible bad debt as soon as possible, while maintaining that good debt, which is going to help you through negatively gearing. Okay, once you've determined your surplus cash flow, you can then determine a plan for what you use your surplus cash flow for. So this will go back to your goals that you've previously set, and these may include saving for a deposit, saving for other personal goals like buying a new car or travel, paying off debt at a faster rate, as I said, that non-deductible debt. So mortgage, credit cards with extremely high interest rates, personal loans, which are exactly the same, and also investing in shares or property. So it's really specific to your goals and objectives and what you want to achieve over the short, medium, and long term. The next big thing that I find women don't know much about is their superannuation. So how much do you have? who holds your superannuation. Is it Sun Super, Australian Super, Vic Super? There's so many options out there. And sometimes when I ask, it's not necessarily just women, but all of our clients, they have no idea how much they have no idea where it is, and the most important thing is that they don't know where it's invested. So understanding your investments, hold on, there we go, is really important. So when you are put into an industry fund, such as Australian Super, you are given a set amount and type of investment. So you might get a little bit of the top Australian shares, a little bit of the top overseas shares, a little bit of fixed interest, and a little bit of cash. But basically, Australian Super has to satisfy the needs of all of their members within the industry fund. These members range from age 16 to age 80 plus, who are in retirement. And those two different categories of clients require very different investments. So picking your investments, which are specific to your goals and objectives, are really important when it comes to your superannuation. So for example, an 80-year-old may choose more income producing stocks. This includes things like Commonwealth Bank and Westpac, which pay large dividends to their investors. Whereas a 16-year-old or anyone up to age, say 40, 50, who's still trying to grow their superannuation for retirement, needs things like Google or Microsoft or Visa or CSL, which can grow the portfolio over time and enable you to have a larger balance at retirement. So potentially hopping out of those industry funds into retail accounts that will enable you to pick the shares within your portfolio to suit your needs. This also is relevant to the structure of your superannuation. And this is something that we go through with our clients in their initial meeting all the time, because it's so important, and it's very, very relevant to what we're going through now with COVID-19. So we have two different types of clients. We have Maxine, who's got an industry fund, and she's in retirement, and she needs to take $6,000 per month as an income in retirement to meet her living expenses. Jane, she's got a retail fund and she owns her own investments, and she also needs $6,000 to fund living expenses. The difference is that Maxine has that structure that I was telling you about before, a little bit of cash, a little bit of fixed interest, a little bit of Australian equities, and a little bit of overseas equities. And she has to sell a little bit of each of those components to take out her $6,000 income per month. This means that while the market is down, at especially a time like this, she's forced to sell when the market's low. And that's impacting the amount of units that she's got within her superannuation fund. Jane, on the other hand, she takes $6,000 from the cash account. She isn't forced to sell her investments because she's picked her investments, she's got the cash account, she's withdrawing the cash, and her shares aren't being touched at all. And as a result, she can just continue to take her income and wait for the value of her shares to increase. We found this to be very true during the global financial crisis. A lot of our clients are structured with retail investments, and this is exactly what they did. They weren't forced to sell their investments when the market was low. They just continued to take their income from cash and waited for the value of their investments to go back up to their normal level. And they find that during a period like this, the stock market will recover a lot quicker than the event passes. So the share market will recover a lot quicker than COVID-19 passes. So taking advantage of different contributions is really important, and making sure that you're maximizing your ability to contribute to superannuation. So we have two different types of contributions available to us. The first is concessional contributions, also known as before tax contributions. Now this includes your employer contributions at 9.5%, and then any salary sacrifice contributions that you make in addition. And salary sacrifice contributions reduce your taxable income. The cap at the moment for these types of contributions is $25,000. The other contributions that we have available are after tax contributions or non-concessional contributions. So the caps for that is $100,000 per annum, or you can do $300,000 over 3 years. So that's a little bit of a rundown about, the basics of understanding your finances and getting to know, the ins and outs of your situation.
Good. All right. I'm sure there's questions. I wrote lots of things, so let's have a chat.
I'll just stop sharing my screen. There we go.
Yep. And sorry, while we were sharing screens, I didn't have the chat up. So for those who are watching in, you can use your chat screen if you have questions, or there's a Q&A box as well, but I tend to like the chat. So I'll just watch those and we'll see how we go. All right. So let's go and start with goals, I suppose, because that's where you started. So I wrote down a couple of sort of goals that someone might have. So as you said, buy an investment property or buy a second investment property or something like that. It's a great goal. One of my own goals is to make sure that I've got $1 million in super.
Yeah.
That you might have various investing goals. You might have goals. You were talking about holidays. I mean, that could be like a goal in itself that you have that has to be balanced with other goals, isn't it? Because it's not a financial goal, it's a lifestyle goal, but you have to make sure that you can financially afford that.
Exactly. It's both. It's a lifestyle goal and it's a financial goal, in that you need to be financially flexible and able to take that lifestyle goal. Our motto at Apt Wealth is plan for tomorrow while enjoying today. So making sure that you're not putting all of your efforts into planning for tomorrow and you miss out on today. So take those trips, but just be aware that they might push your other goals back a little bit, but that's okay. You don't want to be missing out on living for today.
Yeah, I completely agree. I think some of the advice around, give up such and such now and save your extra $5 a day is sort of like, that's my enjoyment today. Like,
exactly.
Yeah. But so long as you've got your bigger picture in mind. Now, what I haven't done with thinking, well, I want $1 million in super, is work backwards and think, well, how much do I need to be putting in? So I actually haven't done that properly. And I suppose that could be done on a calculator or an app somewhere.
Yeah. It's definitely something that we look at. So we will put all of your situation together into a financial plan, and we'll look at your current situation as it stands. We'll look at earning capacity and expenses over time, what goals you want to achieve, and then we'll look and say, okay, well, this is what you're going to end up with at retirement. Is this sufficient to generate the income that you require? If not, how are we going to get you there? What sacrifices do we have to make? Will you downsize your home at age 65, and that will allow you to free up some cash? There are options. It's just a matter of making use of those options and knowing where to look and how to build up your superannuation.
Yeah. And look, I think that if people don't do other savings, I think superannuation really should be the focus. But if your super's on track, then think about other investment goals as well.
Yeah, exactly. If your superannuation is on track, you can then look to invest outside of superannuation. And I think a lot of women around 35, 40, it's a great idea to build this other nest egg to use to fund children's education or travel or new cars, or that's accessible before you retire. So we say that it's really important to have 3 buckets of assets. So the first being your home, a roof over your head. The second is a pool of money that you can access throughout your life to fund things like children's education, new cars, and that sort of thing. And then your superannuation, which is going to fund your retirement. So if you focus on those 3 buckets, you'll be fine.
And I mean, with focusing on super as well, it's hard to think, well, how long are you going to live? Because there's a lot of people who run out of money as well. And those stats that I had at the beginning, I certainly don't want to be living on a pension, a Centrelink pension. And, you know, I plan to live to 120 for everyone that's here. So, you know, that's a lot of life that I'm not working for. It's almost as much life as my working life.
Yeah, exactly.
And so I need to be, like you say, putting money into super, but also having another pot as well, because I might not necessarily want to take a lump sum out of super to do something even after I'm retired.
Yeah, exactly. Yeah, it's having all of those different options available to you. At the end of the day, it's just, you know, achieving financial independence and flexibility, having the options to do things that you would want to do. We have a lot of clients say to us, you know, I enjoy working. I enjoy going to work. I don't want to retire. But what I want is the option to work or not to work.
Yeah.
Then the decision lies with me and not because I'm forced to. I'm forced to get up every day. You know, so that means that they can cut back to 2 days or 3 days, or they can continue working as they were, or, you know, something happens to their health and they have to stop. And they've got the flexibility to take some time out of the workforce.
Yeah. So coming back to super versus saving outside of super, you know, at the moment, interest rates are so pitifully low that if you're trying to save in a savings account, it's hardly worthwhile unless you want the funds accessible, like you're talking about.
Yeah.
So because you can put 25,000 into super, you know, if you put an extra $100 a week out of your own salary sacrifice, there's an extra $5,000 going in a year, and it's not just sitting in a bank account earning 0.1%.
Yeah. And then it's invested. But there are things that you can do outside of superannuation if you do feel like you might need access excuse me, to the funds. So you can start an investment account and you can contribute a regular amount into that account and invest those monies. The only downfall is that in order to really get make the most out of those investments, you really need to look to invest for 3 to 5 years. So if you're, you know, thinking of doing something with the money for less than 3 years, we'd recommend, you know, putting it in the bank where it's fixed and secure. You know that it's there. Even just putting it in a term deposit. You know, I know rates aren't great at the moment, but you're making sure that the money is there. So say you wanted to buy a house in a year, we would never recommend to go and invest it for a year, because, you know, something like the COVID-19 could happen again and your money is at one point halved. And yes, the market's recovered quite nicely since the initial volatility, but there's still all those investment risks out there, and we can't deny that, you know, your money could be half in a year. So allowing a longer time frame is going to reduce that risk.
And then looking at property, I mean, property seems to be such a priority for Australians, and I think we worship property a little bit. but I'm a little cautious about property. I don't know about you, because I certainly see the bad side. You know, being a lawyer, I see the landlords having issues, and I see the expenses that go in to maintain property. And so if you want property, yes, it can have big gains, but if you want a set and forget sort of investment, property is not that, is it?
I mean, there's two stages of life where property
Would
there's
suit.
one stage of life where property can be beneficial, and there's one where it's probably not beneficial. So the first is during your income earning years.
Mm-hmm.
So if you have an investment property, all of the expenses and the income associated with the loan for that investment property are tax deductible, and those reduce your taxable income and provide you with that benefit, especially if you're on the highest earning tax bracket.
Mm.
But come, to retirement years, realistically, you're only receiving about a 3 to 5% income from a property. And then you've got the expenses associated with it. So that dilutes that income quite dramatically, actually.
Mm.
Whereas in superannuation, you don't have those overhead costs of maintaining a property. You can just simply invest it in shares, and you'd think that you would receive a higher income than 3% on an annual basis. So, there's two different, types of,
General stages.
yeah,
Yeah. Yep.
exactly.
Yep.
So,
But even then, like you put, there's a lot of information out there about people buying for people to buy property, but really having the guidance of a financial planner would be best, because again, you're talking about deductible costs, but and that applies to residential property as an investment, but if people look at commercial, there's far less deductible things because your tenant's paying them. So the benefit might not be there. And so again, it's about getting educated, isn't it?
yeah, and I think it's also about, I think what I've found over the years is choosing the right property.
Mm.
Making the right property choice, it's going to benefit you in the long term. So something that's going to grow in value, something that has land, because at the end of the day, the land is what grows in value, not the dwelling that the land is on. And something that's, in a good area that's going to provide a decent income for you. So, if you are going to go down the property route, thinking of all of those things, maybe seeking out a buyer's advocate or someone else that can help you with purchasing the right property for you and your situation.
Yeah, great advice. I always forget about those advocates. What else did I write down? Oh, about expenses. So I think a lot of people forget to average out their annual expenses into a monthly bucket, and then they're like, oh, I've got this big thing to pay for and I didn't take that into account. So that's something to remember to do, isn't it?
Yeah, absolutely. It's sort of making sure you have that little bit of a buffer available to you if something does go wrong, especially if you do own a property. I know when I moved into my house, my water heater went, my
Of
heating,
course.
and that's $1,500. And it's like, well, if I didn't have that little buffer and backup, where would I pull that money from? So just having a little bit of awareness of, okay, there's things that could go wrong. Do I have a buffer available to me?
Yep. And not be so stretched tight that an emergency like that would have sent you to the edge.
Exactly. I think another important thing to talk about when you're talking about being stretched to the edge is when you go and see a mortgage broker, they're going to give you your borrowing capacity at its maximum level. They're not going to consider other areas of your life and other goals that you want to achieve. So we often talk about having a loan or a mortgage that you can pay off in 15 years as opposed to 30 years. So that gives you a lot more flexibility, a lot more leeway when it comes to purchasing a home and being able to maintain your lifestyle rather than constantly feeling stressed about the mortgage and all of the expenses associated with the home. And I think that's something to take into consideration, is not taking what the mortgage brokers said as do or die.
That's
There
right.
are other options, putting more as a deposit if you want less of a loan, or just purchasing a property that's a little bit less than the borrowing capability that the mortgage brokers suggested.
Yep, that's great advice. And I tend to try and give similar advice around, people, why are they buying it? Are they buying the property to impress someone else and
Yeah.
stretching themselves to their limit? Because it's not about that, is it?
No.
Yeah. Ultimately, if you live your life to impress other people, then you're not going to be very happy.
Exactly. It's something that's going to, like, I've seen it many times where people are struggling to make ends meet and they're stressing about money.
Yep. All
And
for an appearance.
it's just not worth it. Like,
Mm-mm.
buy within your means, do things within your means, and, prioritize those goals that are important to you. And that's all you need to do, really.
And look, I think lending's certainly tightened up, which is a good thing as well. And so if people are looking to get a mortgage, I know that the banks are now actually looking at what you're spending.
Yeah.
And
Before.
yeah, so you have to justify that. And so that's even something else. If you've got a goal, then start being really conscious of what you're spending, because the bank's going to pull you up on it.
They also include a little buffer in there, so to account for if interest rates go up. So that's also a benefit, is that you do have a little bit of flexibility in there built in by the banks, but still not necessary to go out and spend. Say you've been given a borrowing capacity of $1 million. Maybe find something in the 750, 800 range and think, okay, this is going to suit us for our goals. We don't need something at the $1 million level.
Yeah, no, absolutely. Some of the other interesting things have changed about credit reporting over the last couple of years as well. And I'm aware that if it's not necessarily default, but if you have a late payment, they're showing up on your credit reports, and you're less likely to get something lended to you, even if there's only 2 or 3 late payments. And that just might be the matter of forgetting. It's due on a Thursday, but you pay things on a Friday.
Exactly. Yeah. And that can show up for up to 7 years. So, it's a long period of time to have a bad credit rating.
Absolutely. So for everyone on here, you can get your credit report for free once a month, once every 12 months.
Yeah.
So the super as well, coming back to that, I just think super is so interesting. And I don't mind using myself as a bit of an example here as well, because I suppose I'm in the age bracket where it's okay to have units at the moment rather than a retail fund so much.
Yeah.
So I'm certainly in an industry fund. And I'm paying extra into it than the employee benefit, the guarantee. And I've got it structured as 50% in growth investments, and 50% in index investments. And I think I learnt about the indexing stuff actually when I read The Barefoot Investor a couple of years ago, because over time, the natural movement of the share market is growth. And so if you just follow the index, it will happen naturally. And sometimes that even outperforms a human managed fund.
Yeah, that's very much the case. So there's, for all of you who don't know, an index is what's called an exchange traded fund. And an exchange traded fund follows the index of a particular industry. For example, it might be the top companies in Australia. And it's just basically a parcel of shares that's wrapped around together that follows, that particular index. So how it works is, if it's the top 100 Australian companies, it'll hold all of those top 100 companies. And then when one falls out, it'll be replaced by the new 100th company. And it'll just track that particular index and how those companies are going over a period of time. And they can definitely be beneficial to a portfolio. And how we use them is they are the core of the portfolio. They provide low cost diversification to specific industries, specific geographical locations that you wouldn't be able to obtain otherwise. So you think about obtaining the top 100 Australian companies. Well, you'll need a minimum investment of, say, $5,000 in each of those companies. So, that's already a large sum of money to get exposure to 100 companies. And that's not even including exposure to other areas of the world like Europe and the US and other other countries. So it's a way of achieving diversification at a lower cost. So we use those as the core foundations of the portfolio. And then what we do is we stock picks in other areas. So we might choose a few Australian direct companies. We might choose a few direct US companies. And all of those stocks are used to build your specific portfolio.
Mm-hmm. Yep. And we're still talking all inside super at the moment.
Yeah. Well, you can do that. You can do that inside super. You can do it outside super.
And so because you're mainly doing retail funds as well, you've got much more flexibility than I would in an industry fund.
Exactly.
But some industry funds, and mine does, allows me to use some of the money I've got in super and do direct investment as well. So that's handy too.
Yeah. Exactly. So you will find a few industry funds that will allow that.
What else did I note down here about super? Oh, yes, I do just love that example that you have those two women side by side, because it's so relevant depending on time of life and I suppose what happens in the world. Like, you can't predict what happened this year. It's just been a shit year.
Exactly. And that's
although,
we never forecast for something like this to happen. This is completely new territory for everybody. And something like that could happen in the middle of your retirement, which is what has happened for a lot of people. And a lot of retirees are having to, say, for example, the value of a unit used to be $1, and now the unit's 50 cents. So instead of selling 6,000 units at $1 to make up your $6,000 income in retirement, you have to sell 12,000 units to get your $6,000 of income in retirement. And that's putting a lot of pressure on a lot of retirees out there, which is why we focus on retail funds that allow for holding specific investments and then having a cash account where you can take the income from. It's really, really important.
And it's certainly something, as I get older, I'll look at a retail fund, but at the moment, the industry fund suits. So again, the time of life thing. But I think even the unitized investments is important to be aware of, because again, I've got investment outside of super that is unitized. And so at the moment, it's obviously good for me to be putting more in because I'm buying units that are cheaper, and those going to go up later.
Yeah, it's really good for those in accumulation phase in retirement. There's no real difference as opposed to flexibility of investments. You're still going to be, putting in your regular contributions from your employer, or also your salary sacrifice contributions. You're going to be entering the market at a lower rate and then growing the value of your fund. But it's more for that retiree that's having to withdraw funds to support their lifestyle.
Yep. Because they don't have any more income to put in, so they're relying on what they've already accumulated.
Exactly.
The only other note that I wrote down as well was to make sure that the term deductibility was clear in terms of talking about what good and bad debt was.
Yeah, yeah, I can revisit that. So deductible debt is where, like I said, expenses associated with that particular investment. So whether it be, so say for example, an investment property, you can claim the interest associated with the investment loan and then all of the expenses to do with the investment property against your income, which will reduce your income and reduce the tax that you pay. Your mortgage, on the other hand, doesn't allow for that. All of the expenses you incur can't be deducted, just like a credit card, same thing, and a personal loan. So it's just taking advantage of those deductible debts. You can do it in two ways. If you don't want to put any more money into property because you feel, okay, I've already got the family home, I want to diversify and I want to put some money into shares, you can then borrow money to invest in shares, and the interest payable on the loan for the shares is deductible against your income.
Yeah, no, that's great. Because I'd originally heard a good and bad debt scenario, and good debt was debt that made you money and bad debt was not. But it's better to have, as you said, the definition around deductibility, because it's clear when you think of your main home, like the mortgage is obviously, it's an asset that, yes, is going to increase in value, you hope. But because the mortgage on your main residence is not deductible, it's actually not good debt. So pay that off.
Yeah, exactly. So you think about an investment property, not only can you claim the expenses and your investment property is going to grow in value. So you're getting two benefits there. Your mortgage, yes, it's your place of residence, it might be your dream home, but at the end of the day, you can't do anything with those expenses associated with the home. But yeah, it is going to grow in value. So there's really only one benefit there.
No, that's great. And it was also good to focus on it. We're not just talking mortgages as debt. You can also have an investment loan, and same thing, the interest is deductible. Yeah, so that's important, isn't it? Because you, with both those sort of investments, in investment property and with portfolio of shares, you've obviously got extra income that you're also making during the year as well as your wage. And so that gets added on. So you want to try and have as many deductions as you can to counter that extra income.
Yeah, exactly. Because you need to, that income from all of those sources is accessible income to you.
And so I think a lot of people don't fully understand what negative gearing is, which is that the extra income on your investment actually doesn't pay for the property. You've got more deductions than the income on. It's not that you have more expenses than your income in total, because you then add your wage on as well.
So you think about rental income. So say you're getting $2,000 of rental income a month, but then you're paying $2,200 of interest per month. And then you're paying things like the owner's portion of the water bill, your rates, your from corporate, if it's an apartment or a unit, insurance, and all of those expenses go on top. So clearly the interest alone is more than the rental income. So you're negatively gearing by having greater expenses than the income.
Yeah. So people doing that are really hoping that they'll get a nice refund, and that's almost their way of saving, isn't it?
Exactly.
But it can make things tight as well if they've sort of, what we were talking about before, just not allowed enough room to move.
Yeah, exactly.
Yeah, okay. Well, I think those are all my notes. I really like the app, and I really like to try and gamify these things, because I think it just adds an extra incentive, doesn't it? So it's nice when you've put a budget into an app, and if you achieve it, you get a green week or a green month, or versus a red. And I hate those red ones. So
yeah, exactly. It forces you to stay accountable, and it does do that. It screams to you in red that you've gone $10 over your budget for the month, and it's only the 10th of June, and it's like, oh gosh, okay, I need to rein in my spending, and I need to focus on what's actually important to me.
Yeah. And I like also, I think the app, or all the apps generally, it makes it easier than some of the bucket strategies that certainly the Barefoot Investor recommends, because you have to have multiple accounts and you have to track them and blah, blah, blah. But if you just have your goals in an app and it's all using the same place, you can still have buckets in the app, but it's all the one account. Much easier.
Yeah, exactly. Yeah.
Good stuff. All right. So, parting words, how do people contact you? Other resources you can direct people to?
Yeah, so I work for Apt Wealth Partners. We're on Collins Street, but at the moment working from home. So if you want to contact me for an initial Zoom meeting, it is free of charge. And you can contact me at emily@aptwealth.com.au, or you can call us on 87795254 with a Victorian number, so 03. And on our website, we have a whole lot of resources that are free and available to use. So you can contact me and provide your email address, and I can set you up to our Knowledge Centre. And that provides videos and blog articles on different topics that may be of interest to you. Some of those you don't need to provide your email address to me to obtain. We also have a COVID-19 website, which is linked to our website, which is aptwealthpartners.com.au. It provides you with all the information you need to know about any Centrelink benefits that you can obtain, how to go about this, also just tips and tricks for surviving this time as well.
Yeah, great. Now, with the app that your company offers, I understand that you've got different levels of service as well, because some people might be like, well, I don't have enough wealth to actually have, a financial planner. Well, you can have your app.
So we have 2 tiers of clients. We have a full service offering client, which is, $3,300 to prepare a financial advice piece. And then there's an ongoing fee that is dependent on the complexity of your situation. But for people who just want more basic advice, there's no upfront fee for a statement of advice. And then the ongoing fee and access to the app is $99 a month.
Why wouldn't you?
Exactly. That amount is tax deductible to you as well. So like I said, it's good to spend that money, because it's going to cost you, say you're on the highest marginal tax rate, it's going to cost you $600 instead of $1,200.
Yep. It's an investment.
Exactly.
Yeah. Good stuff. All right. So I put your email into the chat if anyone wants to cut and paste that before we end. My email address, I'll also pop that in there. I'll email everyone out this recording so you can go back and zoom through what you're not interested in, or remember, I remember they spoke about this, and you'll be able to go back and find that. I think that it's just so important. I think women have to get over the fact that we're not good at maths. Of course we are. We're just as good as anyone else at maths. And to be honest, finances are not hard maths anyway. It's usually just adding multiplication and percentage. It's not trigonometry. It's not, other more complex maths.
It's also quite empowering to, take control of your finances and be the one who is making the decisions in the household, because You know, you don't want to leave that to your spouse. You want to be able to contribute to the conversation. You want to be able to make decisions together.
Mm-hmm.
And yeah,
that's a great point. I think that some of the stats are that women make 80% of the consumer choices for a household. So why aren't we making the same decisions, the same percentage of decisions financially? Why do we make all the decisions about what we're eating and who our phone company is and where our kids go to school and what they do extracurricular activity, and yet we're not making the decisions about where our money is actually put? So really great. Let's get women more financially literate and get rid of that stat that, you know, women over 55 are becoming homeless.
Yeah.
All right. Thank you very much.
Thanks
I'm
for
going to
having
stop
me.
the recording.